Celsius Holdings Inc., NASDAQ, SEL, stock rose 0.74%, as on September 2, 10 hours 45 minutes and 49 seconds AM UTC-4. Source: Google Finance, after Jefferies initiated coverage on the stock with a buy rating and a $115 price target. The posted consensus target is $96.75. Jefferies Financial Group's price objective indicates a potential upside of 26.51% from the company's current price. Meanwhile, for the second quarter of 2021, the company's total sales were of total $65.1 million, up 117% from $30 million in the year-ago quarter. The domestic revenue increased to 157% to $53.7 million, up from $20.8 million in the year-ago quarter, driven by accelerating triple-digit growth in traditional channels of trade, expansion of world-class retailers, and further activation and growth from the distribution partners. The DSD, Direct Store Delivery Network, delivered growth of 333% in the distributor revenues when compared to the prior year. International sales growth grew 25% to $11.5 million, primarily from a 23% growth in Nordic sales of $10.8 million. As of July 1, the company has over 18,500 vending micro-market placements, and the company expects that growth to continue throughout the year as the company drives additional new national distribution agreements with Performance Food Group contracts and additional several regional agreements. During the second quarter, the company has increased the inventory levels up to $63 million, up 27% from $36 million at the end of the first quarter, to support the growth and increased warehouse distribution centers and to better service the customers and meet demand, as well as increased the inventory of raw materials. On the other hand, the aluminum can shortage driven by COVID and impacting the entire industry remains in place, but for Celsius, the company believes that the company are well positioned from the proactive sourcing of international cans and new relationships with top can manufacturers in the U.S., which have been initiated major expansion projects and continue to expect the completion of this expansion in the back half of 2021 through 2022. The company has implemented the contingency plans around production, and which imported can product started in March of 2021. The company anticipates 50% of the can supply for 2021 be derived from imported and wrapped cans, which should decrease late in 2021 and through 2022. The company expects a significant majority of cans will be sourced domestically in 2022, improving the margins, and at this point the company believes Q1 of 2021 was the low point for margins, with the back half of 2021 owing sequential improvements toward the fiscal year 2022 to 2020 levels.